The global nature of the business world in modern times has resulted in more and more people travelling overseas for work. The first and foremost tax consideration for those earning assessable income while they are overseas is whether they should still be classified as an Australian resident for tax purposes. This is important because Australian residents are taxed on their worldwide income, while foreign residents are only taxed on their Australian-sourced income. Residency for tax purposes should therefore not be confused with the concept of citizenship, which is attributed by birth or immigration. Whether a taxpayer is a resident for tax purposes will depend on the taxpayer's pattern of behaviour in the relevant financial year. The Australian Taxation Office, or ATO, has provided 4 tests to assist taxpayers in their self-assessment, including the factors which will be considered. The Resides test. This is the primary test of residency, so if the taxpayer satisfies this test, there is no need to apply the remaining 3 tests. The Resides test aims to assess the taxpayer's overall behaviour whilst they are in Australia. This involves reviewing the taxpayer's intentional purposes for being in the country, for example, working holidays, short-term contractor, relocating permanently for work, the extent of any personal and/or professional business ties in Australia, social and living arrangements, financial affairs such as the extent of assets maintained in Australia, length of time and physical presence in our country, history of travelling to Australia when not working overseas. If the taxpayer's behaviour is not consistent with someone who resides in Australia, the taxpayer will need to satisfy the remaining tests. The domicile test. A taxpayer's domicile is their permanent home in the eyes of the law. This permanent place of abode must be more than a temporary or transitory residence and needs to be something permanent. The meaning and definition of a domicile is established through case law as there are no clear tests or rules to determine. The domicile test becomes important in situations where a taxpayer goes to work overseas for an extended period of time, thereby failing the resides test. The next test is the 183-day test. This test looks to see whether the taxpayer is actually present in Australia for more than half of the income year. This test is satisfied unless the taxpayer's usual place of abode is outside of Australia. The usual place of abode is a residence which is current or habitual but does not have the same requirement for permanence. The superannuation test. This final test was implemented to make sure current Commonwealth Government employees working in Australian posts overseas are treated as Australian residents, so this test has a limited application. This test is satisfied if the employee either falls within the definition of an eligible employee for the purposes of the Superannuation Act 1976 or is a member of a superannuation scheme set up by the Superannuation Act 1990. The question of individual residency is not always straightforward, but the outcome will determine what income, if any, should be taxed in Australia and whether another country also has taxing rights to any of the taxpayer's income. If the taxpayer is liable for foreign tax, that is, they are required to pay tax in another country, a double taxation agreement may apply to provide foreign income tax offsets so the taxpayer is not taxed twice on the same income. If you need help or would like assistance in this area, please contact us. You're welcome to email us at info@quinns.com.au, call us on 1300 Quinns or visit our website www.quinns.com.au. We'd love to get your feedback in relation to Quintessential TV, so please like, comment and subscribe. We look forward to seeing you all again next time. Bye for now.